All right, hello everybody. So today I want to talk about something that um, seems to me to be a long-term risk to several, not necessarily all, but many blockchains. And it's um, something that I haven't heard a lot of people talk about. It's something that I'm not sure how many people are even aware of. It's something that's fundamentally economic and probably only an investor would take this perspective. It's a very long term perspective, and so let's get into exactly what that is. To do that, I want to talk about commodity type businesses. And for those of you who may be unfamiliar, a commodity type business is essentially a business which produces something that's like a commodity. It's basically fungible. There's nothing that's, you know, intrinsically unique about a particular company producing that. So, for example, let's take a look at some characteristics. So, characteristics of a commodity type business, how do you recognize it? Well, first of all, the absence of any brand name loyalty. So, for example, when you go to the store and you buy um, toilet paper, maybe you pay attention to the brand, right? Maybe you only pick Charmin. But for a lot of people, I think it's relatively fungible. It's something that they go out, they buy, they don't necessarily pay that much attention to it. Another good example is probably bottled water. Now, some people buy bottled water, but not a lot. Sorry, some people buy bottled water of a particular brand, but not a lot, right? I think most people, they go to a store and they're going to get a bottled water, they're just going to buy whatever bottle of water is cheapest. It doesn't necessarily matter. Um, so absence of any brand name loyalty is the first thing. Second thing that you would look for to recognize a commodity type business is the presence of multiple producers. So are there a variety of different companies that all produce this product? The next is existence of or ability to rapidly create substantial excess capacity. So is it easy for a new company or an existing company to ramp up the amount of whatever product or service this business is creating? And finally, profits tend to be erratic for these. And the reason for that is essentially because of this very elastic supply. So, the last point we just talked about, can excess capacity rapidly come online? Can it rapidly go offline? That is something that tends to create, somewhat erratic profits because competition is erratic, supply is erratic, and then if demand is also erratic, then that can further complicate this. So some examples again of what these commodity type businesses would be. The textile business is a very good example. The textile business in the United States, especially for the past, several hundred, couple hundred years. So textiles are cloth, basically, segments of cloth. It's not turned into clothing, it's just cloth. Another example would be farms. So farms have, they basically produce, let's say onions. And when you go to the store, you probably have no idea where your onion came from. You don't really care where your onion came from. It's an onion, so that's that. Same with a potato. It doesn't really matter what farm a potato came from, and most people have no idea where a potato came from. So that's a commodity. And the farm, which is the one producing that commodity, is a commodity type business. Now, again, the reason we're going to get into this is because cryptocurrencies, blockchains, some of them at least, rely on commodity type businesses. And again, I'll get into exactly why that is. But for now, the important thing is recognize that blockchains rely on these commodity type businesses. And now consider the economics of commodity type businesses. Are they good businesses? Because if blockchains rely on commodity type businesses and commodity businesses are not very good businesses, then that is a fundamental problem, because it means that in the long run, our blockchains depend on bad businesses, right? That's what we don't want. So here's the characteristics of a commodity type business. What would we expect from a commodity type business? Well, in the long term, if you look at commodity type businesses, they tend to have low profit margins, and that is on average. So in the short run, there can be periods of time, and there usually are, because of the boom bust cycle of a commodity type business, there can be very large spikes in the margin. So from time to time, you might have a year or a couple of years where the profit margins are extremely high. However, those tend to be counteracted by really bad times or just really long times when the profit margins are negative. The second long-term expectation for a commodity type business is a very low return on equity. So you take the earnings per share, divide it by the shareholders' equity, that's the return on equity. It's basically, for a given amount of capital that's deployed, how efficient is this company at producing a return? It's very similar to return on investment, the difference being that, return on investment, if I buy a share of stock in the stock market, that money doesn't go to the company, so the company can't use all of that money to make more money. Rather, I'm paying that to another investor. And that other investor may have paid less to the company to actually get that share in the past. So return on equity is a better measure for how efficient a company actually is. The third long-term expectation for a commodity type business is centralization. So in the end, because there is no brand awareness, because of the fact that commodity type businesses tend to have this very sporadic life cycle, because they tend to have low profit margins and low return on equity, in the end, it tends to be that these companies merge, a lot of companies fail, and the one that wins in the end will be a company that is just ruthlessly efficient, has very good management. They have access to resources. So, for example, in the textile example, that might be access to cheap power, and or they have partnership with some sort of branded distribution. So again, going to the textile example, suppose that you had a company which didn't only produce textiles, but it also was part of a single company that also produced its own clothing, right? Because now the textiles are not being sold on the open market, they're just being used to feed in a lower cost to the clothing portion of the business, and the clothing portion of the business can then be branded. So that would be a partnership with branded distribution, and that could allow a commodity type business to survive, because it's not actually a commodity type business anymore. It's a commodity type subset in a vertically integrated business that has a branded endpoint. So let's look into, actually, let's go back here for a second. Yeah, so the historical analogy in a little bit more depth for the textile industry is pre-1880s, sort of textiles were becoming, automated, right? There was automation that was going into the textile industry, and this is essentially the Industrial Revolution. Around the 1880s, that sort of peaked, and it started becoming more of a difficult business to be in, because that high technology, right? It used to be that the textile mills were high technology, and when that technology started becoming more common, it became more possible for competitors to pop up, right? And with more competition comes more price competition, which means generally lower profits. However, from then until, through 1930, right? So the next 50 years, basically the industry did less and less well. So textile mills had a more and more difficult time making high profits. Their profit margins generally shrank. You get a lot of companies just slowly going out of business. You also had a shift from, it used to be northern companies in the United States, so Northeast. There were a lot of northeastern textile mills. And the reason was that in the Northeast, there was access to capital, so people could invest in mills because people had money up there. And the second reason was access to cheap power. So up there, you had basically river power was very cheap, and so you could use that to power your mills. However, going forward, as we got towards 1930, and especially as we went even later, it started becoming a thing that southern mills, which used to produce the raw materials for textiles like cotton, figured out that they could also mine coal. And when coal power started to become more of a thing and steam power from coal, then that started to compete with the Northeast, and the Northeast no longer had this special position in terms of being, having access to cheap power, because now the South had access to just as cheap or even cheaper power. The northern mills sort of responded, around 1930 and around that time period by, sort of shifting to more expensive specialty, finer thread textiles, and that, the southern mills weren't quite equipped to handle that yet, so that sort of staved off the problem for a while. But still, it ended up, it only sort of delayed the problem, because the industry still overall was not doing well, so it sort of stagnated a bit, and then eventually southern mills started becoming better also at doing these finer fabrics. And again, the competition problem, bore its head. So from 1930 until World War II, we basically had a bunch of textile mills go out of business, and we had a lot of mergers. During that whole time, pretty much most textile mills were either unprofitable or had very low profits. World War II provided a temporary relief, and during World War II, because of the war demand, suddenly there was this spike in profitability, so textile mills were now making a lot of money again. However, that didn't last very long. After World War II, there was a brief bit of just kind of general prosperity, but that wore off, and the overall arch of the industry came back into play, and again forced most of these textile mills to become unprofitable or have very, very low profits. Then you come, basically all the way up until 1950 and 1950s. You had this trend continue, same problem. In 1955, you had Berkshire Hathaway, which was formed, and at that time it was just a textile company. It was formed from the merger of a couple other textile companies. And when that happened, their goal was to basically be this massive, economy of scale. So they had a bunch of mills, and their idea was, we're going to be able to produce things like the most efficiently, the most efficient way. Basically, like, they were trying to win the industry, by becoming this massive, efficient player. Yet they still didn't succeed, because they ended up still having to compete with the southern states, which had cheaper labor and cheaper power. And over the next 10, 15 years until the mid 1960s, that the industry was still terrible. Basically, they had overall net losses. And Berkshire Hathaway during that time did terribly. They ended up with a net loss after 10 years, from 1955 to 1965. That's how bad it was, right? 10 years, and they were overall down by like 20%. So that was a serious warning. That's also when Warren Buffett sort of steered the company in a different direction. So he started diversifying and putting some of the capital from Berkshire's textile business into insurance and other sorts of businesses. And doing so was the best idea. But even going forward, they still had the textile business for a while, and it just was never a good business. It was always sort of very low profits or negative profits. So why does this matter, right? Let's go forward to crypto. The textile mill has a very close analogy to Bitcoin mining, right? Bitcoin mining, there's no brand. So textiles, if you're selling some fabric, if you're making clothing and you're buying fabric, you don't care necessarily like where you're getting the fabric from. As long as it's equivalent quality, then it doesn't matter. A fabric is fabric, or a certain type of fabric is a certain type of fabric. Similarly, Bitcoin mining, nobody cares like which miner mines a block with their transaction in it. So there's no branding. There's many producers, And the supply of Bitcoin miners is relatively elastic and pretty much indefinitely scalable. I mean, despite the fact that we've had sort of this chip shortage recently, that's a short-term issue. It's not going to be around forever. So in the long run, it'll pretty much be like, in the past where, yeah, you could always buy more computers and scale. So, and they're generally getting cheaper over time. So supply of Bitcoin miners should be similarly relatively elastic and indefinitely scalable over the long term. You also have the fact that the volatility of Bitcoin and of the number of people interested in Bitcoin mining are both erratic. So the profits are erratic. So we have a lot of these characteristics, right, of a commodity type business. Also, you have the huge capex that kills profit margins. So the same thing that happened with the textile mills, in those periods of high profitability, they would take that money and potentially like throw it back into more mills. But then when the when the price of that good decreased, or their competition caught up with them, suddenly there was too much capacity again, and basically they didn't use that capital effectively because they just reinvested all of the profits in the short, highly profitable time, and when they got to the less profitable time, all of that money was now locked up into assets that weren't being very productive. Same thing happens with Bitcoin mining, right? You saw this last year, and in the end, from the end of 2020 through 2021, you saw this, which was a lot of Bitcoin miners, with the huge bull market in Bitcoin, they were suddenly hugely profitable. But they took all of that money basically and reinvested it into new hardware, more Bitcoin miners, and now Bitcoin is down a bit, and a Bitcoin miner only lasts, maybe 2 years. So how quickly is the price going to ramp up again? Because these Bitcoin miners paid a lot for their Bitcoin miners. With the price of Bitcoin going up, the price of the miners went up, and these companies spent their profits buying those more expensive miners, only to have the price of Bitcoin go down. And now basically they have a couple years at most before those miners are less efficient than newer miners, and you'll have other companies buying the newer miners. So it's this sort of constant loop of like investing your profits when you have them into more capital expenditure, but then the capital expenditure doesn't have this very long lifetime, and it spends some time being inactive when price of the commodity decreases or when there's too much competition. So it's this vicious sort of cycle. And in the long run, sort of the most efficient miner wins in terms of having the best business, right? They'll have the best chips, they'll have the best management of capital, they'll have the cheapest access to power. And if you imagine, over a very long time period, why would these companies coexist? Why would you have multiple Bitcoin miners that are all coexisting, right? Because the odds are they're not going to all be exactly the same level of efficient, right? There will be a most efficient one, and investors will only want to invest in the most efficient one. So the other ones will have less capital, which means they'll have less ability to reinvest into their own companies. So unless someone is investing for a philosophical reason because they think that decentralization is good, that's good. I mean, it is, but philosophy in history is not typically enough to counteract a genuinely profitable business. Someone thinking that, oh, it would be nice if this is the way the world should be, we should be more decentralized. Sure, but if you have to compete based on, if you have to have a philosophy compete against a profitable business, then the profitable business is just going to win. They're going to have more money, and they're going to be able to lower their costs until they force the philosophy-based business to go under. So that is the long-term risk that I see for Bitcoin mining, and basically for any sort of proof of work system, is this problem of like the miners are commodity type businesses, and those are bad businesses. So in the long run, I don't see how those businesses escape becoming centralized. That's the major long-term risk. Now, you can ask the question if this also applies to proof of stake. And I think it does, not necessarily as much, but it still does. So let's take a look at that. If we have a proof of stake validator, again, we generally have no brand. Now, there may be an exception to this, right? It may be that, if you are delegating, then you might know the brand name of whatever pool you're delegating to. So there might be a bit of trust there for a delegated proof of stake situation, but it's sort of similar to, it's sort of similar to like a payment system, right? Like with payment systems, there's still a level of trust that's needed. And I think, if the brands have to be built on trust, that almost, financial trust, that almost also is a centralizing force, because if you have no brands, right, you're going to get competed down to the most efficient business. If you have only trust-based brands, then again, you might be competed down. I mean, and you sort of see this with with finance companies, right? Like, how many payment networks are there? Well, there are two, basically, Visa and MasterCard. How many banks are there? Well, there are some, there's a decent number, but most of the money is in a few of the really big banks because they're the most well-known and people trust them the most. And I see, a sort of a delegated proof of stake as being a similar issue, where there will be a few, very well-known, trusted, respected names, and people will want to put their money there. Alternatively, maybe, well, let's get into that. Let's go to something else. We'll come back to this. So proof of stake validators, no brand. There are many producers, right? Anyone can spin up a validator. The supply of validation service is extremely elastic. So anyone can spin up a validator, for very, very low cost, marginally. And you can scale your revenue just by having more coins. So that's very cheap. In a zero inflation regime, so if you are talking about a proof of stake system that has no inflation, so for example, Bitcoin, right? Bitcoin is not proof of stake, but suppose it was. If it didn't have after basically it has no more inflation, once it's reached its cap, then competition is based only on fees, right? And that means that if you can specify your fees as you can with Bitcoin, and there's no inflation, then you're going to get competed down, on fees. So again, the Bitcoin miner or the validator, if Bitcoin was a validated system, would be the most efficient, miner, the most efficient validator. So when we're looking at proof of stake validators, I think it's important for the long run to analyze like the details. Basically, you need a blockchain, a proof of stake blockchain, to satisfy certain properties in order for it to be a long-term sustainable blockchain. And those properties are the properties that are necessary so that these validators could actually be good businesses. Because if they're not good businesses, you won't have enough of them and it won't be decentralized. I am not sure how we get there. I honestly don't know exactly how you could structure this so that, you could have 1,000 validators, right, that are all sort of sustainable businesses. It's hard to imagine exactly how that could happen, because even if we take a look at something like Solana, right? So Solana has an inflation schedule, right? So there will always be some level of revenue there. That's good. So if there's some supply of revenue there that's provided by the protocol, then you're not, you don't have to compete past that. So, right, even if there's no fees, that inflation is sort of, paying the validator. And in that case, that's sort of that's one way to do, right? Like that, you could sort of have a long-term, you'd have a bunch of companies that had, basically their own capital, and they deployed it into a validate, like they run their own validator, they have their own capital, they stake their own capital to run a validator. Okay, that could be, right? They could all, you could have Solana in the long run have, lots of validators that do that. But the question is now, okay, just because you have 1,000 validators doesn't mean that the there aren't a few validators that control the majority of the capital, and that's what's really important for a proof of stake system. So who controls the majority of the capital, that is going to be based on delegation, right? Whether it's built into the protocol or not, right? Some protocols have the ability to delegate built into the protocol, some don't. The ones that don't can still have delegated capital just through something like a normal custody provider. So maybe someone holds their currency on Kraken, say, right? And I'm not delegating on chain. I'm just holding my coin in a centralized custodian, and that custodian is essentially delegated, has my delegated capital that they can stake. So you're going to have these whoever has the delegated capital is going to have the most capital. So what we really need for a long-term sustainable proof of stake system to be decentralized is we need an incentive system where lots of different validators can all be delegated to, and all have good businesses. So let's take a look at that in depth, right? If we have delegation is, again, sort of a perfect commodity type business. Like, what incentivizes a customer to delegate with you? Typically, you offer the lowest fees, or you have the most trust, right? So you could imagine in the future on Solana, say, right, probably there's only going to be a couple wallets that are the most popular wallets, right? So maybe there's Phantom, maybe there's 5 others too, right? Maybe there's 10 others, but there's probably not going to be 100. Probably 10 wallets or fewer will have 90% of the capital, or let's say at least 70% of the capital, Probably 10 wallets or fewer will have 70% of the users, which means, and probably 70% of the capital. So if that's the case, then those wallets, the companies that make those wallets, should run validators, because most of the users will opt for the convenience, and especially if those 10 wallets, have low commissions that they charge to stake your coins, then users will take advantage of the convenience and a low enough price. Doesn't necessarily have to be the lowest, but it'll be low enough. And they'll stake their coins with those wallets and with the validators that those wallets provide. That means that, the vast majority of the capital will be concentrated in those wallets, maybe it's wallets. Maybe you could say exchanges might do the same thing. Like right now, right, Kraken has a lot of capital that's been delegated. Coinbase obviously holds a lot of capital on behalf of people. So basically, like, custodians, whether it's a wallet, which is sort of a self-custody, or a centralized custodian, in either case, the interface to the person, right? The place that the human customer interacts with, whether that be a decentralized wallet or a centralized custodian, the businesses that own those things or produce those things are going to have the access to most of the delegated capital, which means most of the overall capital, which means that those businesses will be the only ones that basically control a majority of the network in the long run, which is not a lot of decentralization, because, as I said, it's very unlikely that you're going to have even 100 different wallets and custodians that add up to 50% of the network. Like, you're going to have many, far fewer than 100, probably 20 or fewer. So that is sort of a major problem for decentralization in the long run. And I don't really know how to fix that. I'm not sure. I don't know what the solution is there. I hope that there are some people that will think about this. And, if any of you have thought about this, or if you have ideas, please leave a comment, because, I've been thinking about this a lot, and I really want to understand the space of possible solutions here. I philosophically am very much in favor of decentralization, but I can't get around this issue that I've been thinking about of how are blockchains long-term sustainable when they rely on either miners or validators, which seem to be, you know, the ones that matter, right? The ones that have enough capital to matter seem to be commodity type businesses, or sort of these heavily branded businesses, right? Where people keep their money there. In either case, they end up being centralized. So that's pretty much all I have for now. I wish I had an answer for you guys. I wish I could tell you that I knew of a particular protocol that solved these problems. I think, you know, I believe that Cardano might do something about limiting how much can be delegated. I could be wrong here. So I think that would be probably the way to start looking into this is you need to control, you basically need to limit like how much money can be delegated to any particular party. That would be the ideal. However, practically, I don't know if that can even be implemented because you sort of run into the problem of like Sybil control mechanisms, right? So even if you at a protocol level say, hey, every wallet can be delegated a maximum percentage of the total currency. So let's say, let's use Solana as an example. Suppose you say every Solana wallet can only be delegated a maximum of, 0.1% of the total amount of currency. Well, okay, that sounds good, right? Because now you've made more businesses, like 1,000 businesses, with 0.1%. That's now, you could have all 1,000 businesses, 1,000 plus businesses that are all, profitable businesses. They can all be delegated. However, that doesn't work because there's no Sybil control mechanism, right? Sybil control means like controlling identities. So you have no way of knowing that there's not one company, right? Maybe Phantom, who makes Phantom Wallet, right? They could just operate 100 different wallets or 500 different wallets, right? If Phantom had 500 different wallets, each one could be delegated 0.1%, then Phantom, the company, right, could be delegated 50% of the network. And they just bypassed that mechanism on chain, right? So when you have sort of interfaces, right, these human interfaces like a wallet that are off chain, how do you ensure, right, like when those businesses can become centralized and tend to be centralized, and there's not 500 different wallets that all have meaningful numbers of users, then we're back to square one. What is the long-term game here? How do you ensure that you don't end up with most of the delegated capital in the hands of a few companies that, just dominate the industry and no one else can compete with them because, they don't have the brand and or the efficiency scale? Something to think about. I will definitely be thinking about a lot. Like I said, I wish I had an answer, but I have not been able to think of what it is. So I hope you guys have some ideas and can share them with me. I'd love to hear them in the comments. Anyway, I will talk to you guys next time. Have a great day.